So you're a federal employee and you have questions about should you get the federal long-term care coverage or is there something else out there that's better? That's what we're talking about today. Hey, my name is Mel Stubbs. I'm here on behalf of Retirement Benefits Institute, and today we're talking about federal employees and how to cover the long-term care exposure that you have. Should you do the federal long-term care or is there a better way? There's typically three ways that you can cover this incident. Number one would be to retain the risk, to be self-insured. If you just have money, if you ever need long-term care, you just pay for it out of your assets. That's the obvious first choice. That would be the one where you are retaining the risk. You're not putting it off on an insurance company. The second and third option, you are putting it off on an insurance company, and you could do it through the federal long-term care, or you could use a life insurance policy. Now, when I mention life insurance, there's three things I am referring to. We are talking about an indexed universal life policy. This is a permanent policy that the death benefit does not run out. So this is not term. It has a premium guarantee rider, meaning the premium stays the same the entire life of the policy. It never goes up. The third thing is it has a chronic illness rider where if you qualify, they will pay money from the death benefit to pay your long-term care needs. Those are the three things I'm referring to. So if you hear me say life insurance, that's what I'm talking about. Permanent policy, premium never changes, and it has a chronic illness rider. Okay, so let's talk about the similarities between the long-term care with the federal government and with a life insurance policy. The first similarity is you are paying a monthly payment for a bucket of money. Let's look here at an example of the federal long-term care. On this slide, you'll see the daily benefit is $250 a day, and you set it up for a certain number of years. The longest you can do it is 5 years. So here, 5 years times 365 days is 1,825 days times the $250. That comes up to a $456,250 bucket of money that is set aside and reserved to pay for your long-term care. You're paying a monthly payment to have access to that money should you need it. In the life insurance, it's very similar. You're paying a monthly payment to the life insurance company for the death benefit. And that death benefit is a bucket of money that you can access early should you need it for long-term care. So first similarity, monthly payment for a bucket of money. The second similarity is how do you access the money? How do you qualify? You'll see on the screen here there are 6 daily functions. These are just things that most healthy people can do. If you can't do 2 of the 6, you get a doctor to write a letter, then you would qualify. Under both the federal and life insurance, both of them have this same qualification to get services. So that's where the similarities end, and now starts the differences. The first difference is the underwriting difference. When you are getting approved for both of these, you have to go through underwriting. On the long-term care with the federal government, they are more picky. They are looking more into your medical history. They're looking for chronic back issues, for arthritis, more specific things. On the life insurance side, they are looking more for mortality, things that are going to kill you. They're not looking at arthritis or bad backs. So getting approved is a little easier on the life insurance. It's not a huge difference, but it is a win for life insurance. The second big difference is how does your monthly payment change over time? For the federal long-term care, your payment does change and has changed a lot. You'll look here on this slide, back in 2010, 25% increase. In 2016, they had an average of an 83% increase in premium, but some people were increased 126%. For those of you that don't love math, a 100% increase is doubling. That is huge. But not to worry, they put in a premium stabilization feature for you. They're almost advertising how good they're doing at keeping your premium stable. But let's look down at the writing. The percentage will be changed no more than once a year, and it will not exceed 100% or be less than 10%. So that tells me they can change it every year, and they can double it every year. A 100% increase is doubling. Now they won't do this every year, but they will do it some years. As you're planning for retirement, it is impossible to know what your monthly expenses will be when you have something like this. Most people sign up for it in their 50s, and by 60, 65, the premiums are so much different that they're trying to figure out if they can keep it or not. This is terrible. Let's see if there's a better way. So how does the life insurance work? Well, remember at the beginning I told you it needed to have a premium guarantee rider. That means that the life of this policy, the premium will never change. 25 years from now, it's the same premium. That's something you can plan with. You can plan your expenses into retirement when you know what they will be. And this is how the life insurance works. So as this comparison goes, the life insurance wins this one. The third difference is, how does it pay out? Let's say you qualify. How do they pay you your money? Well, our two big words for this section are reimbursement or indemnity. So the federal long-term care policy uses reimbursement. Makes sense? You have to pay the bills up front, keep the receipts, every month turn them in, and they will reimburse you. This has a few problems in my opinion. If you are in need of long-term care, you might not be in the best health to keep track of everything. Also, could there be a time where you sign up for services, you receive the services, and they don't get reimbursed? Yes, that could happen. There's also home modification and getting some ramps and certain medical equipment like walkers. They aren't covered under the federal long-term care. So you could be left holding the bag when you get some services and they don't get refunded to you. So that's reimbursement. How does the life insurance work? The word there is indemnity. What indemnity means is they come up with the maximum benefit for that year, and they pay you the full amount at the beginning of the year. Now you have cash in hand and you can go spend the money like you want to. Can you be extra thrifty and have leftover money? Yes, you can. You're now a cash payer and you can negotiate. So you'll never sign up for a service and then find out it's not paid for. You know how much money you have to spend, and so you spend it like you want to. So there again, to me, on the comparison, the life insurance wins this one. Indemnity wins over reimbursement. The fourth difference I call the Plan B. What happens if you don't need it? Now we're all looking at this trying to sign up for long-term care thinking you're going to need it. So let's get a policy that covers it. But what happens if you don't need it and you don't use it and you die peacefully in your sleep? Under the federal policy, you will have paid a whole bunch of money and nobody gets a benefit. That's kind of terrible. Well, how does the life insurance work? Well, remember, the primary reason you're getting life insurance is for the death benefit. So when you die, a beneficiary gets a tax-free death benefit. You're just choosing the chronic illness rider to collect some of that money early if you need it for long-term care. But if you don't need it, the beneficiary is still going to get the death benefit. So nobody's not going to get any kind of benefit. Somebody will receive a benefit from the life insurance, whether it's you for long-term care or your beneficiary if you die. That's a big difference. And so for me, I think life insurance wins that one as well. So let's talk about this chronic illness rider and how does it work. A lot of times you'll see that it is a no-cost chronic illness rider. And if it's no cost, does that mean it's free? And it's not. And here's how it works. It's called discounted acceleration. When you need the money and you qualify, they will subtract an amount from your death benefit, and then they write you a check. Your check that you get will be a little bit less than what they subtract. The difference there is how much it costs. Remember, they are giving you the money early, so there's some time value of money discounting happening. And then also, they're paying you some long-term care benefits, so there's a cost to it. But here's the key difference. You haven't paid for it the whole time. You're only choosing to pay for it when you elect to take the money. Think about any other insurance you have and see if they give you this option. Let's talk about car insurance. You don't have car insurance, you don't pay for car insurance. You have a wreck. Then you sign up for car insurance and they pay for it. Yeah, that doesn't happen. What about homeowners? You don't have homeowners, you have a fire. Now you sign up for homeowners and they pay for it. Yeah, that doesn't happen. That's what's happening here. You're not paying for this chronic illness rider until the time you elect it. When they tell you how much money they're going to give you, you can do some math to see how much it costs and you can decide if you want it or not. The cost will be based on your age, so the older you are, the less the cost will be. But you'll be able to decide if you want to do it or not, and your key thing is you're not paying for it until you actually use it. It's a big difference. So we've gone through several differences between the federal long-term care and life insurance. To me, the differences are huge, and I think it's something that people need to look into. If you need help with your federal benefit planning and planning for retirement, reach out to retireinstitute.com. They can prepare a report where they can discuss these type things. They can also discuss how much your bring home pay will be in retirement, after taxes, after health care, after long-term care. You're going to want that report. So as you need help, reach out to Retire Benefits Institute at retireinstitute.com. Until next time.